In week 3, we continue our study of liabilities, but turn our attention to liabilities that an enterprise expects to be around for a long time. The long-term orientation of these liabilities brings us back to the topic of the time value of money, more specifically present value, as well as other complex topics, including bond amortization. Given the complexity of these topics, we have broken this chapter into 2 weeks, allowing you the time and space to fully comprehend before leaving liabilities. This chapter has been broken into 2 parts. It is my recommendation that you read the chapter entirely for both weeks. Yes, that does mean reading the chapter twice, but it will be worth the effort. Part of our coverage will introduce the concept of bonds more generally and will explore concepts of premium and discount amortization using the straight line method. Part B, covered next week, will cover premium and discount amortization using the effective interest method, the early retirement of a bond, as well how to account for long-term notes payable. Now let's first turn our attention to why organizations need to take on long-term liabilities and long-term debt. First is what we think about all the funds that are necessary to run an organization. We have 2 different sources that we can look to gain access. First is the internal source through retained earnings, so the idea that the company is doing well and organically funding its future growth. Then when that is not sufficient, either for growth or to cover certainly a startup organization, then they might turn to external sources, and this is where debt or equity financing comes into play. As we look to the next slide, we explore the points of distinction between debt financing and equity financing. Debt financing requires a company to be in satisfactory financial condition and offer adequate security to creditors. Interest obligations on bonds must be repaid regardless of earnings, potentially subjecting the firm to litigation for non-payment. A debt instrument has a fixed interest rate and a definite maturity date when the principal must be repaid. Interest is tax-deductible, whereas dividends are not. Holders of debt instruments generally have no voting privileges and present owners remain in control. Under equity financing, an equity security has no fixed repayment obligation or maturity date. Dividends on stock become obligations only after being formally declared by the firm's board of directors. Dividends are not an expense and do not impact net income. Common stockholders generally have voting and other ownership privileges. As we turn our attention to bonds, the most dominant form of long-term liabilities, bonds are essentially loan agreements between the bond issuer and an investor, in which the bond issuer is obligated to pay a specified amount of money at a specified future date. Corporate bonds are the most common form of debt financing. They can be a major source of capital for many businesses, along with equity, bank loans, and lines of credit. A company needs to have some consistent earnings potential to be able to offer debt securities to the public at a favorable interest rate. Corporate bonds are issued at blocks of $1,000 in par value, and almost all have standard coupon payment structures. As the investor owns the bond, they receive interest from the issuer until the bond matures. Upon maturity, the issuer must repay the full face value of the bond. Next, we'll explore how the market price of the bond is determined. The selling price of a bond is set by several factors. They include supply and demand, the relative risk of the underlying organization, market conditions overall, and the state of the economy. It's important to note that there's an inverse relationship between the market, the rate of interest, and the price of the bond. As we look at the definition of premium, face value, and discount, face value is when the market rate of interest equals the contract rate that's embedded within the underlying corporate bond. For example, the market rate is 12% and the contracted rate within the bond is also 12%. The bond would be issued at a price that equals its face value. In contrast, let's move to premium. In a premium situation, the market rate, so what everyone else is offering, is less than the rate that is embedded within our contract. Let's imagine in a premium situation that the market rate is 10% and we are offering 12%. People would flock to our bond to have that guaranteed rate of 12% and therefore would be willing to pay an amount that is in excess of the face value. A discount situation, as you can imagine, is in contrast. In this situation, the market rate is less than the contract rate. Let's assume that the market rate is 14%. Again, this is what everyone else relative to risk is offering out into the marketplace, and we are offering a contract rate of 12%. Therefore, we would have to basically put our bond on sale or be willing to accept less than the full face value to attract investors to our bond. As we seek to quantify the market price of a bond, The selling price of the bond is set by the sum of the present value of the future principal payments plus the present value of the future interest payments. The future principal payment is one lump sum at the end of the maturity date, which is considered a single sum, whereas the interest payments will be paid biannually or annually, depending on the contract terms over the life of the liability. And therefore, it's considered an ordinary annuity. Both cash flows are discounted at the prevailing or the market rate of interest. Interest terminology is an important foundation going forward. Here, we look to understand the stated, coupon, nominal, or contract rate. All four terms are used interchangeably throughout the chapter and throughout the context of this dialogue. This is determined as periodic interest for the time between the date of issuance and the bond maturity. The rate of interest printed on the bond is multiplied by the face value to calculate the amount paid to the investors, whereas the market, yield, or effective interest rate is the actual rate of interest earned on the bond, determined based on the rate of return for comparable bonds that are issued on the same date. This slide represents an important review of your interest calculation. We recall our key time value of money computations. First, we'll start with the present value principal. Keep in mind that a principal payment is one payment at the end of the loan term and is represented as a single sum. We're going to discount that single sum at the effective or market interest rate. Let's explore an example. Let's imagine we have a 3-year bond with $100,000 face value at a 12% stated interest rate, when the market rate of interest, or the prevailing rate, is 14%. Interest payments are made semi-annually or 2 times per year. To derive the time, an important foundation for time value of money calculations, we're going to look at the 3 years and note that the interest is paid semi-annually or 2 times per year. We'll take the 3 years and multiply it by those 2 time periods to get 6 periods of interest. Interest, looking at the market value, is 14%, but it's compounded twice per year. And so, we take the 14% divided by 2 to get 7%. Now we'll look at the present value of a single sum calculation. We'll take the principal of $100,000 and we'll look to the present value of a single sum at 6 periods at 7% to derive 0.66634. Multiply that by 100,000 and the present value of the principal is 66,634. Now, as we look at the present value of the interest. Interest is a function of time payable at the end of the period, which means that it's an ordinary annuity. In order to calculate the interest, as reviewed in the prior slide, we'll take the principal of $100,000 multiplied by the coupon rate of 12%, multiplied by the time or semi-annual interest, or 6 out of 12 months to determine an interest payment of $6,000. We're going to take the $6,000 and discount it at the effective interest rate. So $6,000 multiplied by the present value of an ordinary annuity as derived from the table at 6 periods at 7% gives us a time value of money factor of 4.76654. Multiply that by the $6,000 semi-annual interest payment and we received $28,599.24. Now we're going to take the present value of the principal plus the present value of the interest to determine the price of the bond. And we would expect the price of the bond based on the relationship that exists between the interest rate, the 12% that we're offering versus everyone else in the marketplace offering 14%. We would expect not to be able to get our full $100,000 that we're asking for. We'd expect to have to put our bond on sale or reduce our expectations. And so, when we do that, we derive $95,233.24, and that difference of about $4,700 is due to the interest rates causing a discount on that bond that will be later amortized. As we look to the next slide, we look at the same example through the lens of the 2 cash flows. We have the bond with the present value of the principal, face amount, payable at maturity of $100,000, plus the present value of the periodic cash payments, interest payment calculated at face value multiplied by the stated rate multiplied by time, or $100,000 multiplied by 12% multiplied by 6 months out of 12 equals $6,000. We're going to discount those at the market rate. And we can see from the visual that the time periods for the interest, or we're going to see that twice per year, time 1, time 2 in year 1, time 1 and time 2 in year 2, and time 1 and time 2 in year 3. $6,000 given 6 times over the life of this bond. And then we can visualize the $100,000 face value payable at the maturity date, or 3 years, at the end of that 3-year period. Now that we have a grounded understanding of the determinants of the price of the bond, we look to account for bonds at issuance from the perspective of the issuer. We have 3 examples in the slide. The first example is selling at par value or face value, where the stated interest rate and the market rate are in alignment when the bond goes to market. In this instance, the issuer gets everything that they've asked for. They've asked for $100,000, and they've received $100,000. To account for this, we debit cash for $100,000 and credit bond payable for the liability at $100,000. Next, we'll move on to a bond that sells at a discount. This would be an illustration where our interest rate is less than what's being offered out in the marketplace. Know that bonds are typically stated in terms of percentages of their face value, and that's the determination of the 98%. We're assuming 98% of the face value of $100,000. Because our interest rate was less than what was being offered out to the market, we had to put our bond on sale or expect less. Therefore, when we went to market, we were only able to receive $98,000, and so we debit cash for $98,000. Then I'm going to move on to the credit. We're going to credit bonds payable always at our maturity value or a face value at $100,000. And we establish a new account called discount on bond payable, which is a contra liability account. That brings the liability down to its book value of $98,000. You would take the bond payable, the credit, less the discount on the bond payable of $2,000 to get to the book value of $98,000, which equals the cash you received on the date of issuance. This is a similar treatment to accumulated depreciation from a depreciation standpoint. Next, we move on to the bond selling at a premium. We're going to issue it at 102% of the face value. This would be the instance where our interest rate is more attractive than was also being offered in the marketplace at that same given time. We went to market asking for $100,000. Because our interest rate was so attractive, we were able to get $102,000. So we're going to debit cash for $102,000. Then I'm going to move forward to the credit. We're going to credit bonds payable always at the face value of $100,000. And then we're going to introduce a new account called premium on bond payable, which is another liability account, technically called an adjunct account, but not used in commonplace. And so, we're going to credit that account for a bond payable at $2,000. Next, we move on to accounting for bonds at issuance from the perspective of the investor. Here, again, we're going to use the same scenarios. When the investor buys the bond at par value or face value, we're going to debit investment in the bond. The bond is now an asset that they've acquired for a stated rate of return of $100,000. And they gave up cash of $100,000, so we're going to credit cash for $100,000. Next, we look at the example where they bought it at a discount. They are going to debit bonds for $100,000 at face value, and they're going to credit discount on bond investment for $2,000 and credit cash for $98,000. So again, this was in the instance where, from the investor's perspective, we got a deal on the bond because at the end of this term, we're going to get $100,000 back. Now we should note that there's an alternative way to account for the investment through the net method, which is often the more preferred method. This is where the discount or premium is netted against the investment and the investment is amortized to face value. As opposed to having a separate investment on the bond account and a discount on the bond account, all that transactional activity would be rolled up into the investment in the bond. Finally, we move on to purchasing at a premium. So again, 102% of face value. In this instance, the investor had to give up $102,000 in cash, and so they're issuing a credit to that cash. The investment in the bond would be debited at $100,000 for the full value of that investment, the full value of what they will receive at the end of the term. And then they are creating a new account called premium on a bond investment. As I mentioned previously, typically what's happening in practice is that we are not delineating on an investor perspective with premium and discount, and all of that transactional activity is happening in the investment and bond account. Next, we're going to move on to bond amortization, and we're going to explore this from the perspective of the issuer. Discounts and premiums are amortized and charged to interest expense over the period of time that the bond is outstanding. And this really relates to the goal of amortization. The goal of amortization is to get the bond carrying value to face value by the date of maturity. The way that we determine bond carrying value is to take the bond payable amount, which is always at face value. If you recall back to our journal entries, a date of issuance plus or minus any unamortized premium or discount, depending on the scenario that we're in, to derive the bond carrying value. If we recall back to the bond that we sold at 98%, a bond payable with $100,000, the unamortized discount was $2,000, which gave us our bond carrying value at $98,000. We need to get that to be equal to the $100,000. So, we need to gradually chip away at that unamortized discount. We need a rational and systematic way to amortize or chip away at that discount and slash or premium. We're going to do that by charging it to interest expense. Notice that interest expense is always the offset, regardless of what we're talking about. For example, in the amortization of discount, we're going to debit interest expense and credit discount on bond payable. Again, remember, a discount on bond payable is a contra liability account, which means that its natural balance is a debit, in contrast to a liability. And we need to chip away at it and work it down to zero. So it would make sense that we would be crediting that account. In contrast, we have the amortization of a premium. A premium is a liability account or an adjunct account, and that has a natural credit balance. We're going to need to gradually chip away at that, and we'll do that through issuing debits periodically. And the offset to that account is going to be a credit to interest expense. What's interesting is that we would naturally expect to be dividing an expense to increase that expense. But in this illustration for a premium amortization, we are crediting it, which has an interesting impact on the income statement in that, by crediting interest expense through the amortization of that premium, we're reducing our expense, which ultimately has the impact of increasing net income. In Part A of this chapter, we're going to explore bond amortization using what's called the straight line method. If you remember back to straight line depreciation, it was an easy and systematic way of allocating depreciation. Similar is true for bond amortization. This provides for the recognition of an equal amount of premium or discount amortization for each period. The amount of periodic amortization is determined by, quite simply, dividing the premium or discount at purchase or issuance date by the number of periods remaining until the bond's maturity date. In our illustration, let's imagine that that bond that we sold at 98% or $98,000 with that $2,000 discount would be divided over that 3-year period. We're going to take the face amount of the bond, multiplied by the stated rate, to calculate the bond interest paid. To calculate the amortization in Step 2, we're going to take the premium or discount and divide it over the remaining life of the bond. Then in Step 3, we're going to take the interest paid, and we're either going to increase the interest paid by the amortization of the discount or decrease it, if it's amortization of a premium, to determine the current period interest expense. Now let's look at this final topic through an illustration. On January 1, ABC Industries issued 100,000 of 12% bonds dated January 1. Interest of $6,000 is payable semi-annually on June 30 and December 31. The bonds mature in 3 years. The market yield for bonds with similar risk and maturity is 14%. The entire bond was purchased by United Incorporated. Note that there are 6 periods of interest. Semi-annual interest for 3 years. And if you need a reminder or refresher of the calculated amounts, look back to slide 10. First, we'll look at the journal entries and the date of issuance from the perspective of the issuer. The issuer received $95,233 in cash, and cash is debited to reflect this amount. Bond payable, as you remember, is always credited at face value. So we're going to credit that liability for $100,000, and the difference is debited to discount of bond payable, which is a contra liability account for $4,767. From the investor's perspective, they have given up cash to make this investment for an expected rate of return, and so they're going to credit cash for $95,233. And again, relationally, you should see that cash going out from the investor is the cash that's going into the issuer, and that there's an inverse relationship between that debit and credit to cash. Then we're going to look to investment in bonds. Investment in bonds, without using the net method, is always debited at face value. And so investment in bonds is debited for that $100,000. And then we introduce the discount on bond investment, which is similar to accumulated depreciation, and that is reducing the value of that investment, and that is the credit for $4,767. Now we move on to the journal entry for June 30, and this would be a similar journal entry that would be booked 6 times throughout the life of this bond. First, we're going to look at it from the context of the issuer. We know that the issuer is contractually committed to a cash payment of $6,000. We see that denoted first with credit to cash for $6,000. And then what we would expect without the existence of a premium or discount is that interest expense would equal $6,000. But we must amortize the discount. We have to bring that discount down to zero, so that upon maturity, we have a bond payable amount with a carrying value of $100,000. We must systematically and rationally chip away at that $4,767. We're going to do that by dividing it using the straight line method over the 6 periods to get $795. For this first period, we're going to credit discount on bonds payable for $795. And that increases our interest expense to $67.95. Now, finally, as we look at the investor has the expectation that is contractually committed that they are going to receive cash 6 times over the life of this bond. And they do, in fact, receive cash for $6,000. And again, we see that relationship existing between the bond and the issuer. We also see a relationship that exists between interest expense being debited on the issuer side and interest revenue being credited on the investor side. And then, ultimately, we have the bond discount on the investor that is continually being amortized, again, to bring that full value of the bond investment up to $100,000 at the maturity of the bond.